As a limited partner in a real estate debt fund, you're investing like a bank. You're lending money secured by real estate and earning consistent returns. No ownership headaches, no tenants and no toilets, just passive income backed by hard assets and managed by pros. So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question. This podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations. Welcome to this special series from the Real Estate Underground. We're trying something new with these episodes, keeping them focused, educational, and conversational. A bit different from our usual interviews, but still all about helping you become a smarter, more confident real estate investor. Now, if you've been listening to the show for a while, you know we talk a lot about real estate from the operator's perspective. But I get questions all the time from listeners and investors who want to understand the passive side, specifically how to invest as a limited partner. So in this series, we're flipping the script. We're going deep into the LP experience, how it works, what to expect, and how to make smart, informed decisions as a passive investor. In this first lesson, we're kicking things off with the basics. What exactly is a limited partner in a real estate debt fund? Let's break it down. A real estate debt fund is a professionally managed pool of capital that lends money to real estate investors or developers. In plain English, you put your money into the fund lends that money out secured by real estate, and you earn interest on that money, usually monthly or quarterly. So you're not buying properties. You're not signing on loans. You're becoming the bank. Just like a bank makes money by lending, you make money by putting your capital to work, earning income through interest payments. So what's a limited partner? A limited partner, or LP, is someone who invests in the fund but doesn't manage the fund. You're a passive investor. You're protected from liability beyond your investment, and you benefit from the fund's performance without any of the day-to-day involvement. You're not making lending decisions, or you're not collecting payments, and you're not managing defaults. That's the job of the general partner, the team running the fund. Your job? Wire the capital, track the performance, and collect the distributions. Let's bring this to life with a real-world example. Let's say you invest $100,000 into a debt fund that lends to real estate flippers. The fund loans that capital to experienced operators secured by properties. For example, the fund loans $250,000 to a flipper who's buying a house at 65% of its after repair value. That loan to value figure depends on the experience and financial strength of the borrower. That flipper renovates the home, sells it within 6 months, and pays the fund 12% interest along the way. You, as the LP, would earn 8 to 10% net on your investment, depending on your agreement with the fund. The fund keeps a small cut for managing the loans, and you sit back and collect steady income. No phone calls, no surprises, no drywall dust. What kind of returns can you expect? Every fund is different, but many target 7 to 10% annually net to limited partners. Returns are distributed monthly or quarterly as interest income, which is likely taxable, and sometimes reinvested if the fund allows for compounding. You need to check with your advisors for guidance on how to handle taxes. Just keep in mind, this isn't an equity play. You won't get a slice of the upside or appreciation. Also remember, the fund does not get equity in the borrower's property either. You're a lender, not an owner, and so is the fund. Okay, now let's talk about risk. No investment is risk-free, but here's what makes debt funds relatively conservative. The loans are backed by hard real estate collateral. They're typically underwritten at low loan-to-value ratios, like 60 or 70%, and most funds are diversified across dozens of loans and borrowers. If a borrower defaults, the fund can foreclose on the asset, and because there's built-in equity, the capital is protected. Of course, it all comes down to the team managing the fund, their underwriting, their judgment, their discipline. And that's why due diligence, which we'll cover in a later episode, is so important. Who is this strategy right for? This strategy is great if you want predictable passive income, don't want to manage tenants or renovations, prefer real estate without direct ownership headaches, or simply want to diversify outside of Wall Street. It's especially attractive for busy professionals, retirees, business owners, or anyone sitting on idle cash. If you care about capital preservation and cash flow, this may be exactly the tool you've been looking for. And who isn't this right for? Let's be honest, it's not for everyone. If you need short-term access to your money, want equity upside or long-term appreciation, or prefer to make every decision in the deal, then this might not be the best fit. Debt funds are built for income and safety, not fireworks. A quick note on taxes. Most of the income you earn from a debt fund is ordinary interest income. That means it's taxed at your regular rate, not at capital gains. That's why many investors use self-directed IRAs or solo 401ks to invest through tax-advantaged accounts. We'll talk more about that in a later episode. Okay, let's land this plane. Here's your final takeaway. As a limited partner in a real estate debt fund, you're investing like a bank. You're lending money secured by real estate and earning consistent returns. No ownership headaches, no tenants, and no toilets, just passive income backed by hard assets and managed by pros. For the right investor, this is a smart, repeatable system for building wealth without sacrificing your time or having to ride the stock market roller coaster. In the next lesson, we'll go deeper into how a debt fund is structured, how deals are sourced, how the money flows, and how you get paid. If you enjoyed this format and got some value out of it, leave a comment and tell me what else you want to learn about. Thanks for listening. Bye for now. This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.